Assuming you are 31 years old, and assuming you fund $500 per month, in 1 year you would have funded $6,000. In 10 years, you would have funded $60,000. In 20 years, you would have funded $120,000. During those 20 years, if something happens to you, your family would have received $890,000. If nothing happens to you, this is your money, $173,000. You can use it however you like. However, let's take a look at the first year. How much have you put in? $6,000, right? Even though you only funded $6,000, if anything happened to you, your family would still receive $890,000. But if nothing happened to you, you would have $3,700. If you cancel the policy during the first 2 years, you will receive nothing. Why is that? Because this is a life insurance policy. There are fees and penalties, and they are expensive. On the 5th year, even though you funded $6,000 per year, if something happened to you, your family would receive $890,000. And if you cancel after the penalty, you can only take home $16,000. On the 16th year, you would have $114,000. And if you cancel, you can take home the same amount. Why? Because after 15 years, there is no more penalty. So for short-term planning, this is not recommended. For long-term planning, this is a great product, and I highly recommend it. Let's take a look at the 20th year. You funded $120,000 total. If something happens to you within those 20 years, your family will get $890,000. If nothing happens to you, again, this is your money, $173,000. You can use it however you like. How much have you funded into this policy in 20 years? $20,000. Look at how much you have now, $173,000. You may be wondering, how did my money grow? Your money grows based on these assumed interest rates. Around 7.19%. Are these interest rates guaranteed? They are not guaranteed. They are for illustration purposes only. The actual interest rate is based on the performance of the S&P 500 index. Do you know what the S&P 500 index is? The S&P 500 index represents the 500 largest companies in the United States. Let me give you an example. This is the actual performance of the S&P 500 over the last 20 years. With this product, you can pick and choose between different options on how your money grows. But for the sake of time, let me share with you my favorite option, which is the S&P 12% cap option. With this option, whatever the S&P 500 makes, you get to make up to 12%. But when the S&P loses, you lose nothing and still make 0.25%. For example, take a look at the year 2003. The market generated 17.32%. You make 12%. In 2005, the market generated 5.41%. You make 5.41%. But for the years the market went down, like 2008, 2011, 2018, and 2022, you lost nothing, but you still made 0.25%. That is amazing. So if you take a look at the last 20 years, the average is 8.08% per year, which is pretty good. Here in this illustration, I am using around 7.19%, which is way less than 8.08%. So we are being very conservative in this illustration. This column right here is showing you what happens to your money if the market performs at 7.19% every single year. The middle column is showing an example of what will happen to your money if the market performs at 4.75%. Now let's take a look at the guaranteed column. This scenario happens if and only if the S&P 500 goes down every single year for the next 20 years. Worst case scenario, you would still have $50,000. However, when the S&P 500 goes down 2 years in a row, what do you call that? A recession. And if the S&P 500 goes down 4 to 5 years in a row, what do you call that? An economic depression. Have you ever experienced an economic depression in your lifetime? Most likely not. It only happened once in the last 100 years, in 1929, when the market went down 4 years in a row. So let me ask you this. If an economic depression has never occurred in your lifetime, and it has only happened once in U.S. history, do you think the S&P 500 could ever go down 10 years in a row, or even 20 years in a row? Could that happen? It could, but it is very unlikely. If that happens, none of us would be around. So this guaranteed column, in my opinion, is not very realistic. But by law, we have to show it to you. However, the non-guaranteed column is a more realistic example, because the last 20 years averaged 8.08%, which I showed you earlier, and that is similar to the 7.19% shown here. For example, in year 28, say you have roughly around $300,000, and say the S&P generates around 7%. How much would you have earned? $21,000, right? So if we take $292,000 plus $21,000, it should be $313,000 plus, right? But why does it only show $312,000? Because they take a few $1,000s to pay for the cost of insurance. What if the S&P 500 goes down? Like negative 38% in 2008? Would you lose anything? No, you would not lose anything, and you would still make 0.25%. What if the S&P 500 generates 20%? What is the maximum percentage that you can earn? 12%. Now let's say after 20 years, if you stop funding into the policy and assume that you do not take any money out, and you let your money continue to grow, by the time you reach age 67, you would have $494,000, and you can cash out a single lump sum. Or starting at age 68, you may take $38,000 per year, every single year for the rest of your life. Let's say in the next 4 years, you would have taken out $152,000. How much total did you put into this policy? $20,000. And again, how much have you taken out total? $152,000. Even though you have already taken out $152,000, your family would still receive $718,000 if something were to happen to you. And if nothing happens to you, you still have another $468,000 more to take out. And if you have never taken any money out, you would have $640,000 in your policy. And if you continue to live, you can still continue to take out $38,000 a year, all the way to age 91. You would have taken out a total of $912,000. Again, how much did you fund? $20,000. Are you in profit? Yes, even though you have already taken out $912,000. If something were to happen to you, your family would still receive $439,000 extra. And if nothing happens to you, you would have $334,000 more to take out. If you had never taken any distribution, you would have $200,000 in your policy. And if you continue to live, you can still continue to take out $38,000 a year, all the way to age 120. You would have taken out a total of $214,000. Again, how much did you fund? $20,000. And if something were to happen to you, your family would still receive $1,246,311. And if nothing happens to you, you would have $1,246,311 more to take out. If you had never taken any distribution, you would have $11,041,721 to cash out. Now that is a legacy to leave behind. Living benefit script? Now on top of all this, there is more. This program comes with a feature called Living Benefits. Living Benefits means you can be the beneficiary of your own policy. Living Benefits allow you to access up to 90% of your death benefit even while you are still alive. This is our client from Chicago. She is a 34-year-old female with 2 kids. She bought this policy 2.5 years ago. When she bought this policy, she was in good health. 2 years later, she went to a regular checkup and found out she had colon cancer and severe condition. Imagine how devastating this is for someone so young, with 2 little children who still need her love and support. She called one of our agents to see if she could file a claim. After we submitted all the doctor documentation, 4 days later, the client received a check for $312,000, even though she had only funded less than $10,000. She was beyond relieved. This money lifted all her financial stress and gave her the strength to battle cancer. 6 months later, we called to check up on her and found out she was cancer-free. So we are not saying money cures cancer, but it surely helps.